The market feared a black swan event. When one began to surface, the hope was that the WHO would not declare a global emergency. But now that they did output a notification, the markets were quick to ignore it because Amazon shares did really well. Makes sense, right? Of course not. This is a broken market, underlying it a broken financial system, rewarding maximum risk-taking and punishing those who speak out against the gambling with leverage, derivatives, and other nonsense. Today we are embarking upon a journey of madness, one which cannot be reversed. You came here for the truth, so let me unveil that for you. Today I have a jam-packed episode. I'm going to go in all directions. I even have some charts waiting on the sidelines in case I have enough time. We're going to cover everything today, and I wanted to begin by taking a look at this because it's going to set up the rest of the video. Asia stocks mostly rise as official Chinese manufacturing data meets expectations. What about that other big piece of news out there? Did they forget about that too? Well, you can see at the bottom of the page, the World Health Organization has declared a global health emergency. You know what's going on. You're hearing it in the news. Obviously, you're seeing the reports, and the markets seem to be ignoring it entirely. First things first, we had a little bit of a scare, and the markets reacted to it. Things actually got worse, but because the WHO didn't declare this as a global health emergency, stocks said that we don't have any reason to worry just yet. Then the WHO comes up and actually declares it to be a global health emergency, and what happens? Stocks ignore it. Amazon shares are clearly more important. This is when you know you have a problem. And there are many people, both high and low, that have spoken about how fantastic it is that there is complacency in the market. We should be ignoring all of this. We don't have to worry about all of it as long as nobody sells. As long as everybody stays in the market, that goes for the hedge funds, for the central banks, for the individual investor. As long as nobody sells and everybody just keeps buying regularly, the stocks will continue to increase, right? Because that's how it works. We have seen report after report after report telling us that the days of the recession, the days of the crashes and bear markets are over. They're done for. They're never going to happen again. And unfortunately, for so many people, they're going to be burned, and it's going to be worse than they saw back in 2008. It's going to be worse than they saw in 2000 and 87 and every other previous cycle because the complacency is higher than it has ever been before. I don't know when it's going to happen, but the longer it takes, the worse it's going to be. It's healthy for the market to correct. Why don't people understand that today? It's as if they forgot about it. If there is a global health emergency and the stock market came down by 5%, by 10%, maybe that's a good thing. This gives those who want to buy the dip an actual real opportunity instead of buying the dip after the market goes down for a day or a half a day. This is absurd. This is ludicrous, and it has never been seen before like we're seeing it today. You are witnessing history in real time. Fourth quarter GDP rose only 2.1%, and full year 2019 posts the slowest growth in the 3 years at 2.3%. Even with all the manipulation, even with all the cover-ups, they still only got it to such low levels. But of course, we see this time and time again where the data gets revised down, the data gets revised up. Nobody really knows what the real numbers are. To me, it doesn't even matter because the Federal Reserve is there because they love us. The Fed adds $82 billion to the markets in 2 repo operations. As long as the Federal Reserve is there, we got this taken care of. And if you look at the balance sheet of the Federal Reserve, I've been showing you this, just giving you some progress updates, and you can see that it had moved up in the last week. The balance sheet obviously being so important to what's been happening. The complete correlation between the expansion of the balance sheet and the stock market is there. It's obvious for anybody paying attention. Jerome Powell doesn't see it though. I think he might want to get that prescription change on his glasses. Even the central bank in Canada said this: given the weakness in the global economy, we could have considered a cut to ensure the Canadian economy wouldn't perform below its potential and pull inflation below target. But given the state of the financial vulnerabilities in Canada, we judged the risk of reignited an acceleration in house price expectations and a buildup of debt was too high, and that could make attaining our inflation target harder in the long run. This is what they're doing. Pumping up the markets. They're pumping up the house housing as well. People get into debt. Obviously, the cheaper the money is, the more debt they're going to take on. And then they say, well, we don't want to cut interest rates because it's going to fan the flames even further. Do they not realize how low interest rates are already? This is unbelievable. Now, going back to the issue of China and the WHO, is it so interesting that China is the second highest donor to the WHO? The United States is number one. There's a lot of money going from China to the WHO. I'm sure that gives them some friendly considerations, $130 million worth. I don't know what's going on the inside. I don't necessarily want to speculate. I just found it interesting. I found the chart, wanted to bring it to you, and I'll leave that up to you to decide. These two are out of order. I just wanted to show you really quickly US quarterly GDP. You could see it going back to 2009, how it's been looking. Over the last few years, it's been pretty consistent, hanging around that 2% mark or so. It would be very difficult to get higher unless they are able to actually force people to spend more in some way. We'll see if they're going to actually do so. Imports contribution to the GDP. I found this interesting because you can see going all the way back to the financial crisis, there have been very few moments where it's been in the positive, and this right now is the highest level since the financial crisis. In terms of percentage, it is low, but on a historic basis, to me, it's an interesting tidbit. I'll say that. Mexican economy suffers its first contraction in a decade in 2019. It barely contracted, it's in the negative 0.1%, but this is yet another country that's suffering. Look how many in Europe, look at South America. I mean, there's so many out there right now that do not have the strength that they should, considering the fact that we are now in the easiest monetary policies ever in history. The yield curve inverted yet again. Wanted to give you an update on this. This is the 3-month to 10-year, but don't worry, this is all because the Federal Reserve is playing around. Everything is actually totally fine. No need to worry. Copper futures losing streak. This is the record high as far as I'm aware. This chart goes back to 88. We haven't seen this before, and you could see that the price of copper has been declining rapidly, and that generally is a sign that there are worsening conditions. It's an extremely important commodity when you look at it on a global level. Something really doesn't make sense here because we're seeing so many different economic indicators, freight, copper here. I mean, so many that I've shown you before, and that doesn't make sense when you compare it to the stock market and the complacency that we're seeing there. Something definitely is off. Yes, the farm bailouts. We talked about this many times before. While well below historical highs, Chapter 12 family farm bankruptcies in 2019 increased by nearly 20% from the previous year. I want to make something clear. This is after 2 rounds of bailouts. Billions of dollars going from the taxpayer to the big agribusinesses in the United States, and still there are so many that had to go bankrupt. That's just the way it is. Part of it, of course, is the cleansing process, getting rid of the small family farms and going to these big agribusinesses. Very few human beings work in there, lots of machinery, lots of businesses like tractor manufacturers and so on that are able to profit from all of this, but less so for that small farmer. They never got the bailouts, they never get the handouts. It's just the way it is. And this is going to lead me into the next few charts here. Scott Minerd is from Guggenheim. I've shown you reports from him before. There is no doubt that we are in the everything bubble. Pick your asset class and prices are up. But the heavily indebted corporate sector is vulnerable if the economy begins to slow. That's absolutely correct. But if you ask the certain individual that replied below what he thinks, certainly a different opinion. Regardless, this is a fact. It is an absolute fact what we're seeing today. Look at Tesla stock just as one example. It was up nearly 11% at one point, hitting 642. This particular stock was at something like 180 in June, and now today 642. Extreme change that we have seen not only in this stock, of course, but in all the trillion-dollar corporations out there, the tech companies, and so many others. There is certainly an anomaly happening right now, and this chart depicts part of that. Reduced trading liquidity in US equities for the S&P 500 is at an all-time low. So what is it? What exactly is going on today that's different from what we've seen before? And that is, we are watching the most unprecedented stock buybacks that we have ever seen in history. There is absolutely no question about it. This has been documented countless times here on this channel. The share of equities owned by the top 1% has been pro-cyclical. That's the chart on the left-hand side. And on the right-hand side, the share of equities owned by the bottom 90% has been counter-cyclical. So if you're looking at the chart on the right, you could see over time, they're owning less and less and less because they've got more and more debt. Not even the supposed good debt. We're talking about the credit cards and the personal loans, the loan sharks, and all of that. That's very, very bad. That is extremely dangerous because we're talking about such a large percentage of the population. The top 1% accounts for the majority of positive equity and mutual fund demand from household flows as of the third quarter 2019. They give you all the numbers here on this chart, but I just wanted to mention that because it is correlated to that data. It's overwhelming. Focusing on the chart on the left-hand side, equity allocation among the top 1% is near the highest on record, and you could see right now, 61%. I'm sure between the third quarter of 2019, that's the last bit of data from what we have right now, there's a big change. It's gotten way more than 61% just in this short period. People are overextending themselves, and I do believe we're going to see a reversion to the mean on this statistic in a matter of time. Now the buybacks here, you can see where they have gone over the last, let's say, year, not quite as high as they were before. It's still significant. They still are the primary buyer based on the last data that I've seen. I want to get new data on that for you to make that very clear. I just wanted to point it out though, that this has been diminished over the last few months. And you know me, at the Money GPS, I always like to include a bit of humor. You could see the banks race to sell the first post-crisis managed synthetic CDO. That's what you need. You don't want that organic, natural ingredients. No, not at all. You want that synthetic stuff. You want to be able to leave it out for years and years and years, and the flies won't even touch it. Well, apparently JP Morgan, Nomura, and BNP all want to touch it. They all want to get their hands on this stuff. And why? Because it's infinite profit. You create something out of nothing and make billions and billions of dollars. And then when you screw it all up, your friends in the government are going to bail you out. They're going to do it every single time. Nothing's ever going to go wrong with the big corporations. And when you see something like a bankruptcy, which doesn't really happen much to these kind of corporations, it's all about consolidation, power in the hands of fewer and fewer people. To finish off the video, I wanted to talk about Ray Dalio. He posted this on his LinkedIn. After saying cash is trash, he seems to be including currencies as part of the suggestions for people to diversify. When you don't know, the best investment strategy is to be smartly diversified across geographic locations, across asset classes, and across currencies. Not sure what's going on. I mean, that is obvious. You want that maximum diversity. I do agree. But I think there's a lot of question marks, not just for Dalio, but in the global economy right now. I'm going to end the video there. If you found it informative, hit that thumbs up button. When you hit the thumbs up button, you're supporting this channel. I want to thank you very much. As this channel goes down, 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 each and every thumbs up means more and more. So thank you very much. If you want to learn about e-commerce, if you want to learn about passive income, what are you waiting for? You hear me say this every single video, and yet you haven't checked out the Amazon GPS. It's completely free. I teach you what you need to know, the AmazonGPS.com. If you want to learn about the financial system, I teach you in these two books. Make it very, very easy. It's quick, it's concise. I hope you'll check them out at the link in the description. If you want the audiobook instead, that's at themoneygps.com. You want the how-to and solutions? Well, you came to the right place. This is a playlist called How To and Solutions. Check it out. I'll see you there.